Ladies and gentlemen, with the Brotherhood of the Ninja Nerds, the Hello Ladies Gang, and the Muscadine Mafia, please rise. Exactly. Fake it till you make it. And now, ladies and gentlemen, we welcome our own Ryan to the stage. Yes, to receive his diploma for a wonderful, wonderful, wonderful. Don't cry, Carlos. Presentation of the diploma. Oh, how great it is. Hello, Ryan. How you doing, my friend?
Great. How are you?
No, I'm wonderful. I'm fat and happy. Ryan has finished what? I don't know. We've been done about a month or so, Ryan. And but we didn't want to do your graduation because I think you were losing too much money at the time. You were like, dude, let's get it. Let's make some money first.
Give it a minute.
Yeah, let's give it a minute. Let's get back up. And plus, you were doing a lot of research on the on back testing as well, which was kind of cool.
Yeah, definitely.
So Ryan kind of got here through Trey, and I would imagine Trey's here today. So you and Trey were big buds, and so Trey went through the mentorship, and then he somehow taught you into going through the mentorship as well, Ryan. So tell us about that and your relationship with Trey and how y'all keep each other accountable.
Yeah, definitely. Trey and I have known each other for a long time now, at least 15 years, and have been trading together off and on throughout that time. And mostly futures trading over the years, but it's great because he went through the mentorship first with Bobby and said really great things, and then I had joined the community and started learning the 112 and decided to do the mentorship as well, and that was really great. And Trey and I hold each other accountable by sharing our sheets with each other and frankly kind of talking every day, just talking through different things about what we're seeing.
So tell us about your journey through the trading path. A lot of us started with Tasty Trade and we kind of go here and we go there. What was your journey?
Yeah, so it's been predominantly futures trading, mostly intraday. And, it's I found, because I work, the ability to manage trading like that is not very realistic. And I had explored options trading back in, it was like I started in, I think it was 2016, and it was with Simpler. And so, got a pretty good exposure to options at that time, but I couldn't really make the trading work. I couldn't make it profitable for me. And so, so I kind of took a little break from options trading.
Well, the great thing about you is you asked a ton of questions. You were very analytical. That's probably your nature, though, right? I mean, that's how you probably are in real life and in your professional life as well.
Yeah, for better or for worse.
Yeah. And you just kept digging and digging and digging, and you had all these great things. So what were some of the conclusions or some of the things that you figured out about yourself, about your strategy, the things that you changed through the mentorship?
Yeah, I was trading the 112 prior to the mentorship because I wanted to get a feel for it. And I realized as I got into the mentorship that, I was doing that without a trading plan, or I was kind of to the best of my ability using your trading plan, but that was very much no substitute for having my own trading plan. So, I think one of the major things that I learned over the course of time was that I needed to really have my own trading plan, and it was, I have elements of your trading plan in mind, but it was pretty ground up. I also think that I really explored like all of the aspects of the trade and risk tolerance. And, frankly, it came back to very similar to how the original structure and your trading plan is designed, maybe with some additional risk additions that I've added. But, but the kind of risk features that you have around delta, and theta and buying power, which, I played with stretching, certainly during the SVB crash, kind of taught me a lesson that I need to stay within the spreadsheet limits.
What I love though is during our sessions, you would come to these conclusions and you would immediately open up your trading plan and you would make changes to your plan on the fly. How is that? Is the trading plan pretty solidified now? Or are you still finding you're making changes? What are you doing?
Yeah, so one thing I realized is I needed to not have the trading plan reflect something that I did after the fact. There was a moment where you said to me, "Hey, Ryan, I'm not sure," and I'm just going to say this a lot. It was a good moment for me. It's like, I'm not sure you have the discipline to follow the plan. And it was a good wake-up call for me, because what I was doing was I was exploring what to do, and I would go in and retroactively adjust the plan to accommodate what I had explored. And I think in what I learned through that experience was that what's better is to investigate, analyze, really talk with you, talk with others. Like I talk with Candy now a lot, and just trying to get a sense for if this thing that I'm considering is a helpful addition or not. I also definitely now have a lot of back testing tools that I didn't have before. So instead of forward testing ideas, I'm back testing ideas. So it gives me a lot of confidence. So when I get to the point where I'm going to put something into the trading plan, which is something I will be doing proactively in trading, moving forward from that point, mostly it's around risk control and adding ways of managing in, the cases where things get out of control.
So you said you developed some confidence, and I would have never taken you as somebody who lacked confidence coming into this, but tell us about how you increased your confidence in trading.
Yeah, I mean, the thing about day trading, and that's kind of what my background has been, is, it's kind of wicked, right? Which is like, some days are good, some days are bad. And, if you're, Tom from The Best Loser Wins, I'm sure every day you can stamp out good days, but that's very difficult. And so, I came in with a, win sometime, lose sometime mentality of trading. Obviously, in my longer term portfolio, it does quite well, but in terms of the actual day-to-day trading, for me, what I love about the 1-1-2 setup and the trades that people are making in the community generally is they're longer term. So it's more like I'm putting risk on, and because the odds are in my favor because I'm selling premium, really changing that style. Like even if I go back to, 2016, when I first started with options, it was buying premium, not selling premium. So certainly being on the side of the odds has been a really nice transition. And, for me, kind of like the ability to sit back and, let the account do its thing, so like today you wake up and, market's moving in a good direction, you're making money and didn't really have to do anything. To me, that gives me kind of confidence that, decisions that are being made along the way are good, and, money can kind of just evaporate into the account.
We talked a lot about psychology, trader psychology going through there. What part of that helped you? And was psychology a big part of what you were doing in trading prior to us going through together?
Yeah, it's interesting. I had you at the beginning of the mentorship, you had made this comment, or this recommendation, which is to read Trading in the Zone. And then when I finished that, I think I made it to whatever his book is before that, which was also good. And I made the comment to you, which is like, this is probably the third time I've read this book. So I had done a lot of, consumed like pretty much anything there was out there on trading psychology, position sizing, just all sorts of material. I think that the change in my psychology that happened this go around was, there were a couple of things. One is, once I really got a handle on extrinsic value, this was actually a conversation I had with James in the community, and he made a comment, which was kind of like simple, but it like totally changed my mind. And it was, hey, when I notice that I'm losing money for the day, I just notice that the extrinsic value is going up. And I kind of look at those two numbers and, it may oscillate from one to the other. And this is really easy to see in Tasty Trade. It's a little harder to see in Thinkorswim, but we figured out how to get to that. But it's really awesome to see, like, okay, the market's down today. Like, hey, maybe this is a good opportunity to put on a trade. So all of a sudden, this like market being down, losing money temporarily, that creates opportunity. So it's almost like it's like a reversal of how I would normally think about that kind of move in the market. And then also, like, I track in my spreadsheet both my actual net lick, but then I also track the extrinsic value and then the addition of those two numbers. And I pay attention to that to see like what's my expected P&L over time. And so anything that happens in like even go back a couple of days ago where we had a couple of days of pullback in the market, I'm not freaking out. I'm just like, okay, well, I know what my stop rules are. I know how I'm going to get out if it becomes a mess. And so, knowing that the odds are in my favor, knowing really what's happening, you and I had a lot of conversation around, is the change in current price due to price in the market, or is it due to increase in volatility? Like what's causing the current P&L move? Are the positions at risk or are they not? Understanding what's going on with the portfolio. So all that gave me a lot of confidence and psychology to stick with the trade.
Ryan also did some things with the spreadsheet. He kind of used a similar spreadsheet to my format, I think, that you downloaded or uploaded on Google Sheets or something. And you added your own things like learning the extrinsic value, what your extrinsic value was, putting that in the spreadsheet. You made a couple of things that were really neat too. You wanted to see like when you were going to get a margin call because you were really focused on the left tail black swan risk.
Yeah, I was because, I have part of my personality is I have an ability to take on lots of risk. And so that's a good and a bad thing. It can be a bad thing because if I don't know the risk and don't appreciate it, then, it's a blind spot, right? So I was trying to get a sense for the blind spots. During what was going on with SVB and my IRA account, I actually did get a margin call. And it's because in an IRA account, you'll get a call at the 12% level, which is different than at the 20% level for a normal account. So that was something that I was unclear on. And so now I have rules in the spreadsheet. I put in the 12% P&L for the day, the 20% P&L, and the -3 EPR. And I look at the P&L for the day and I compare that to my net lick. And then I use the Thinkorswim margin rules to identify whether or not I will be having a margin call that day, which then I can proactively, do something as opposed to like waiting for a phone call. And I'm not afraid of that. Like if I do get a call, it's like, okay, just deal with it. It's not a big deal. I actually, a comment I'll make on this, which is, I think that the margin calls generally are good. I mean, they're there to protect you. It's a signal that, you've taken on a little bit too much risk for your account, and it's a good time to, pull back a little bit on the risk given what's going on in the account.
Now, talking about you being a risk taker, y'all, if you remember all of our previous graduates, Ryan has a similar risk tolerance as Candy. So you two are gunslingers. So it's kind of cool that you and Candy have kind of met up now and y'all chat and talk a lot too, right? So I'm sure you're getting a lot of valuable insight from Candy as well.
Yeah, I mean, definitely. I mean, we're doing a lot of work right now around, what's the line in the sand around when it's a good time to get out. I mean, you and I, Bobby, you really encouraged me to go down the path of exploring COVID because I was concerned about this, left tail risk. I mean, frankly, everybody in here appears to be afraid of that risk or at least aware of it. It seems to be the thing that we're all worried about the most is this left tail risk. That was the whole Sweet Bobby hedge. And obviously diagonalization can make, understanding your metrics difficult. But despite that, the effort was to try to manage on the downside risk. And yeah, I think like the difference between when I kind of started everything, a few months ago and now is I do feel like if another COVID-like event happened, I would have the tools to deal with it proactively before an account blowout, which, you know, is a very real risk.
Now, everybody will surely want to know, is trading your only gig? Are you full time with it? How much time do you spend per day? Kind of give them an idea about that.
Yeah, it is. Well, no, it's definitely not the only thing that I do. I have a very busy job. You know, this is, I had to get to the in the beginning, you know, when Bobby and I were, you know, meeting every morning from 8 to 9 in the morning, which was a great time for me with my work, to be able to meet. And then, you know, we had to get to the point where I got to the point where I realized if I'm spending more than 15 minutes a day on my trading with the 112s, that I'm spending too much time on it, because I'm probably fiddling and I'm probably, you know, not doing the account any good. And Bobby made that comment. He's like, look, I find the more that I fiddle with the account, the more likely it is to cause problems. And what he even particularly said is said, hey, Ryan, you need to trade one time a day, get in, get out, be done. And if maybe the market's going crazy, then maybe in the afternoon you do it one more time to get like some adjustment in. If you really need to like make an adjustment, kind of get in, get out, same thing. So for me, it is very, very isolated. And I really do try to only trade at one point in the day. Usually it's like a 15-minute window, and I'm managing 2 accounts in that time frame. That's putting in all my metrics, looking at my risk, going down the check down of, you know, what I need to think about as far as risk, putting on new trades, recording them all.
So my trading plan is down to 4 pages. I'm interested to know how many pages yours is now, because you added quite a bit of things to it.
Yeah, but I also
highlight-
pulled a
can-
lot out. I mean, mine is, let's see, I'm looking at it right now. Yeah, it's longer than yours. Yeah, mine is, yeah, mine's 10 pages. Yeah, mine's
Yeah,
not-
that's what I thought. That's what, and there's nothing wrong with that. It's you got very detailed. I mean, you really got in the weeds in the trading plan. You got really specific on some things. Can you kind of, you know, you knew what the major trading plan that I use, but what kind of highlight some of the differences in the way you're trading that you developed through the mentorship to the present?
Yeah. Well, I do have a section in the beginning of my trading plan, which is around beliefs and psychology. Just what are some of the nuggets that I had learned specifically through the mentorship, you know, and maybe pulling from other trading psychology books. And, you know, as I, you know, pull in things from the ongoing sessions I have with Bobby or Candy, just kind of pulling those into like the frame of how I should be thinking about trading generally. But then as I get to the metrics, you know, I'm paying attention to delta, obviously. You know, it's funny, when I first started, I mean, I didn't, it's kind of amazing in a way, but like I didn't realize that I wasn't spy weighting my delta. And I know that sounds like such an amateur mistake, and it was. And then when I did, I was like, oh my gosh, I'm like way over on my deltas. So you know, note to self, everybody, make sure you spy weight your deltas. Also, I had, you know, by default, TOS has, you know, it margin as opposed to margin requirement as opposed to BP effect. And BP effect is a little more effective because that's the metric that the margin department is going to use to look at your whether or not there's going to be a margin call. So anyway, I look at theta and I look at buying power. I played with all sorts of stuff. I played with, you know, delta to theta ratios and, you know, Vega and all these other things. And Bobby in particular encouraged me to take Vega out of everything. So I now no longer look at Vega because I was trying to manage the Vega risk, and it's kind of a losing game because we're in the business of making money off of Vega in a way, you know what I mean? Like the reduction in as VIX goes down, I mean, that's when we're making money. So, you know, I have the check down, which, you know, Bobby likened it to, you know, Nick Saban's The Process, and just having a process for how to do things. And the same thing here. So recording the metrics, looking at the delta and buying power metrics, getting the extrinsic value, asking myself if I'm comfortable with the risk. I look at, I have a specific addition in here, which is, you know, this is not unlike yours, Bobby, at 5% that you were playing around with. I have one at 10%, which is if the account P&L is down 10% for the day, then I just close all positions. It's just a like break glass type rule, you know, because that frankly during COVID, those kinds of things would have happened. And it's just hey, the market structure is falling apart. Let's just break glass here. Then I look at buying power and delta, and I pay attention to, you and I did a lot of work around when to roll, when not to roll. I did a 30 option delta roll during the SVB crash, and it went great, like honestly, and also martingale. I doubled up. So that was something you and I were playing around with. And I think that, I'm trading with a reasonably big account. And so the reality is, like, when I would do something times, something. So I don't know what I had on at the time, maybe like, I don't know, like maybe it was like 17 ES 112, so 34 naked short ES positions. And you double that up and you're like, oh my gosh, that's like a ridiculous number of positions. So, I kind of lucked out in that, but I did like note to myself here, which is like, hey, I don't want to do that again. So, I'm not going to martingale at all. And frankly, I added in some additional logic, which is, if the VIX is above 35 and the option delta of my naked shorts gets to 30, I'm starting at 9 usually, sometimes all the way down to 6, but usually at 9. But if they get all the way to 30, then I'm cutting loose. And that's when the VIX is above 35. I'll roll if it's at 30, I'll roll out and down for a break even. I'm not doubling up. I'm maintaining a 1-to-1 ratio on that roll. But I am cutting bait when the VIX is above 35, because I'm just saying to myself, look, like, things are starting to fall apart here, and let's just protect the capital that's left. Played a lot with buying power. So, in the spreadsheet, I tried to get really specific around, like, what do you do as buying power does certain things? Like, what happens as buying power creeps its way up? So it's like slowly grinding its way up to 80+%, and there's a lot of things you can do. You can, buy some puts to bring your buying power back down. You can sell futures. I tried to really create some rules and like the difference between what's a rule and what's an option. And what I kind of said was, look, if you're getting the slow grind up to 80%, then I need to start pulling back a little bit on the buying power by adding in some long puts. And yeah, also kind of like I added in some logic around this was some conversations with Candy, but it's like, hey, if there's a huge move in the day, like you have a big 1.5% move with news, or a big 3% move, like regardless of what's going on, like these are big moves in the day. Like that's a moment where you're like, okay, like let's sell some futures. Let's kind of put your fingers in the dike is the phrase that is in my head around getting the deltas in line. But I don't do that on normal management. If I get above my portfolio limit on my deltas and things are in normal conditions, I just let it happen. I'm okay with that. And then, yeah, again, I'm just obviously, rolling. So that's some of the stuff. Also, I'm only putting in the 112 if the VIX is below 35. If we're in a situation where the VIX is going crazy, then I'll not. The other thing too is I'll sometimes run into situations where the theta value is too high, and I was running in the account too hot at one point. It was a signal to me that that above 0.3%, it's too high. And so if I'm between 0.1 and 0.3, then it's fine. But if I'm above 0.3, I'm saying, let's not add any other trades. So those are some of the changes, Bobby, that, in the way that I lay out my plan.
He got really serious about back testing. He bought eDelta Pro. He subscribed to eDelta Pro. He subscribed to Option Omega. He subscribed to Option Net Explorer, all three of these back testing software to make sure, y'all. Now, this is amazing. You've heard us say, well, how would we do during the COVID crash? We've all said that, and we think that we have the tools to survive the COVID crash. But Ryan took that even deeper and said, listen, I want to make sure I don't blow out during the COVID crash. So you mentioned some things in your plan, but kind of tell us how you came to the conclusions and what those final conclusions were, because I know everybody's going to know, how do we survive that COVID crash?
Yeah. Yeah, and I'm happy at some point to share my screen too.
Sure, go ahead. You can do that anytime.
Okay, yeah, I'll give the highlights and then I can do some of the sharing. So, it's funny. Option Omega is frankly great. Of the three tools, that's the one I like the most, and it's only $100 a month. And the way that I look at it is, I'm like, $100 a month to not lose money is kind of like nothing. So, it's just important to really understand what you're trading. Everything looks great from 2021 to 2022. I mean, you couldn't be in a better market for the 112. The way that we've orchestrated it, it makes money. It's really great. During COVID, it's pretty dangerous. So, and I'll show what I'm talking about here. It's thankfully manageable, but yeah. Okay, so first thing I was going to say is that, look, y'all can see the screen. Yeah, I think so.
Yes.
This is literally the number of, so I'm looking back since like a month ago. I've done this many tests in the last 30 days. To put it in perspective, like, it's like you really wanted to understand and explore the space. And you can also put it in these portfolios, which is nice. So it compares it against the S&P. So you can kind of see how you're going against that. This is what, I have this at a $1 million starting account level, just because, in Option Omega, it starts at either 100 grand and I just add a zero to make the math easy. So it's $1 million. And I'm maxing all these trades out at, well, this one trades every single, no maximum, but this one has 17 maximum positions, which, if you look at in my spreadsheet, I used about 600 grand of Netlick as the baseline for the analysis, which is, what you can kind of see here and in here, and I'll walk into that. But the point I'm trying to make here is that about 17 112 positions in the ES, that's about maximum for an account that's about 630 grand. So I started with this number, so it's the thing that's important is you should kind of think to yourself, okay, I would be here in this account that's at 2.2 million, and I'd actually only have 600 grand in this account. I would not have 200. I would not have 2 point something million. So it's kind of an important detail. And this is why you can see where you would lead, you would end up in blow up territory. Like with that much on, you go from 2.2 million down to, about 200 grand. So that's an absolute blow up. And that's left totally unmanaged. So this is 17 max positions. I do a 90% profit target. That's like managing at 21 DTE. It's pretty similar. This is your standard 112 structure. This is at a 9 delta. This is at 60 DTE. I typically trade a little further out in DTE than 60, but I just want to do 60 because I know that's what people here normally do. So it's like, look how beautiful this risk curve is, and look how beautiful it is here. It's just, it's like, this is real. And so the question is what to do about it. And so the reality is, of all the things that I looked at, long puts, selling futures, all the things, the thing that seemed like it had the most safety was having a stop. And the way that I think about that, a 275% stop is effectively a 9 delta moving all the way up to a 30 delta. That ends up being about a 275 percent stop, and that's what's reflected in my plan. So you can see here that this drawdown is way more manageable, like significantly more manageable. This, you would still be in business. It's okay. We can fine tune it even further. I played around with what happens if you make sure that you're not entering at a certain VIX level. So I mentioned that I don't enter when I'm not going to enter when the VIX is above 35. There's just too much going on in the market at that time, and it is just we are not in like normal territory when we're above 35. So that makes it even a little bit better. There's a little bit even of a lower drawdown. You can see here, this is at 20% now. Your KGAR is lower. And that's because you're pulling in this, down period. You can even go in and if you're so inclined and you want to go out and if you do 100% stop with the 60 DTEs, you kind of end up in a scenario where you're pretty flat for the year. And if you're down here at 100% stop with 120 DTE, it actually smooths it out, and you make some return. So yeah, I mean, what was the big takeaway from, and Bobby, you mind if I go into kind of the COVID timeframe?
Sure.
Yeah. So, I mean, so OptionNet Explorer is a cool piece of software, and it is not dissimilar to what you can do in the ThinkBack in TOS. But the problem with the ThinkBack in TOS is once you get into the ES contracts, it looks at the current ES contracts. It doesn't go all the way back to the time period you want. So it's like, when you look at, anyways, it doesn't really work. So if you go into OptionNet Explorer, you can put on positions on those days like you were trading it, and then see what happens day by day and click forward. I mean, it's really actually a pretty amazing piece of software. The P&L downshift of these 17 112s, again, not MES, ES 112s, was again high, like down, worst case scenario, down 900 grand. So, this would have blown out an account. That's the kind of the point here. You end up to like literally negative net liquidation. So the question is, well, why and what happened? So the VIX over time, if you start on the 20th of February and you work your way through into kind of where COVID was, or the COVID uptick, you can see that you started at a 17 VIX, which is not too dissimilar from where we are right now. Price was down at 3,300. And then I looked at the change in price. I imagined, what if I had a full book of positions on this date? And then how much of a move down from this price and how much of a move up in VIX from this VIX happened over time? I mean, you can see here that the VIX increased by this date 68 points, which is crazy. And the ES moved up 28, 34% at the very high point. And this is really rough. Like, I don't know if you remember what it felt like back then, but like, this is a negative 7% day. This is a negative 10% day. This is a plus 9% day, which is actually a big problem. And I'll explain why in a second. Another negative 10, negative 9, plus 10. I mean, these are wicked days, right?
Yeah.
And you had a wicked day here, a negative 5% wicked day. This is a pretty good signal to say like, oh my gosh, things are going crazy, right? VIX is above 35, negative 5% move on the day. P&L took a beating. Negative, I would have been down 11% on the day with the P&L. I mean, many things tell you this is a good moment to get out. And that would have been pretty good because, that would have been what, like, that would be like, I don't know, 12% of the account down.
Mm-hmm.
I mean, that's a lot different than a blow up. And we looked a lot into like, what if you manage your deltas? And what if and we looked at all sorts of stuff. We did the VIX hedge, we did long puts, and using Option Omega to analyze what do we think the value of the long puts, if we put on like 3% of our account into long puts, what would happen and how much by day P&L value would come into the account. And the reality is not that much. Like at 3% of your account, those long puts, they turn into something, but not enough to blunt all of the negative P&L damage that's happening from the 112s. And the other thing, and so you'd run into some margin calls. I mean, you would be running into margin calls here, like on the 28th. If you did nothing, you run into margin call here. Remember what I said, the margin call is not necessarily a bad thing. A margin call on the 28th, that would be a big red flag for yourself to say, geez, I probably should be, something's changed. I'd be down 100 grand, but that's a lot different than being down 800 grand. Or 188 grand, sorry, it's a lot different than 800. You'd still be in the game, as you say. Whereas if you put in these long puts, you do get a margin call much later. That's the thing about the long puts. The long puts give you buying power relief, no doubt about it. And there probably is a way to put on enough of them where you can benefit as price continues to move down. I just was looking at what if you applied 3% of your account proactively before the crash and what happened throughout the crash. The problem is, again, it's just not enough to blunt the P&L. Your P&L would still get kind of into the point where it's negative, and obviously you would be liquidated. Futures are interesting because even if you bought enough futures to kind of really hedge your deltas and get your deltas not to neutral, but at least to within spreadsheet limits, you'd be hedging with a bunch of these positions. I mean, down here, look, 289 MES positions. So that's like 29 ES short futures positions. Like, the reason why this is dangerous is because this plus 9% day that happened, it would be frighteningly costly with this many 18 ES positions, right? And you would end up in a situation where your P&L would on that particular day would have gone down to 90 grand, and you'd blow out the account. Long way of saying, the learning from all of this is, most of the time the 112 is fantastic. And actually, like, I'm of the opinion that, all of the extra hedging, for me, I'm not going to do it. And more, what's important is like, hey, just as long as we have some stop rules that aren't too sensitive, that are getting us out when things are going crazy, it's like we can weather a really bad storm. It's okay. We'll take a P&L hit, and that's fine. And it's very rare. And to me, that gave me a lot of comfort.
What I like is if you'll scroll up a little bit on that, the P&L percentage on the day, or P&L net lick change percent. What was it?
This right here.
Yeah.
Is it? It's for the day, P&L daily change. This one. Yeah.
Yeah. So you can see that even with the COVID crash and all that happened, we had time to get out, right?
Mm-hmm. Definitely. There were so many early warning signals in here. And I think, to me, what's important is knowing those signals, like having them in your plan proactively, because it's really kind of easy to just think, well, I'll just weather the storm. It'll be okay. Last time this happened, price came back to here. I just did nothing and things recovered and it was okay. I really think it's like, it has to be like written and in the plan. Otherwise, I think it's hard to act on.
Mm-hmm. Glenn says higher VIX seems like the best time to enter these trades. What did you find that made high VIX less worth the trade effort?
I was just trying to avoid layering in trades during COVID. So it's very rare that VIX is above 35. And when it is, it either happens for just like a couple of days and it reverts right back. So what, you're going to miss like 1 or 2 trading days. It's not a big deal. The problem is it can be the moment. It can be the thing that happens before something really bad happens. So like in this case where it got all the way up into the 80s, it's like, well, not putting on more risk at 35 would have avoided, the problem. I mean, the other thing too, if you think about it here on the 20th, this where you have all that risk. Well, if I had waited until VIX got above 35 and started loading on trades here, because it seems like a good time to put on trades, from 35 to 85, that would have been deadly. You know what I mean? So it's like, I'm just trying to avoid any of the damage that happens kind of in a window that looks like this.
John wants to know if you could repeat your stop loss rules.
Yeah, sure. So I make a decision at 30 delta.
Now this is for a 112 becoming a 30 delta, not a 111, right? So you're doing 112s mostly.
I'm doing 112s.
Yeah.
I'm doing something that's a little bit more aggressive, because you're doing 112s at a 6 delta. I'm doing 112s at a 9 delta.
Gotcha.
A 111 generally is a 10 or 11 delta. So Ryan's a lot closer to a 111.
Yeah.
I would say delta wise.
Okay.
Yeah.
Good.
Yeah, I'm trying to kind of minimize the cost of the put debit spread is where my head's been at, Meaning like only taking some of the benefit of it, not all of the benefit. At any rate, yeah, so I am making a decision when a naked short option gets to 30 delta. At that point, I'm making a decision. Do I roll out and down, or do I close the position? And that's based on the level of the VIX. So the VIX is above 35, at least in my plan, I'm going to close that position out for a loss. And if it's above 35, sorry, if it's below 35, then I am going to roll it out and down. And something to think about when you're rolling. First of all, the reason why I'm rolling is because it can be danger zone above 30. You know, you get to 30, get up to 50, you get up to 70. So I know, Bobby, you wait till 15, and I think that's just fine. For me, I just wanted to kind of cut it at a point that was a little bit lower at 30. And, you know, when you roll out and down, you know, you do take that loss when you roll. Like, it's not just like, oh, it's rolling for break even. It's like, no, that's a loss in your account. And then you're establishing a new position, which is supposed to make up for the loss that you took from the position that you closed or rolled. But I mean, the reality is you're just opening up another position. So I'm not opening up new positions at above 35 VIX. And so that's the same reason why I'm not going to roll a position that hits my stop at that time. Because you know what, the danger with it is, and this is what I found in OptionNet Explorer, which again gave me so much of a color for what would happen. I rolled out and down at 30 delta, and man, it was like every 3 days I was having to do that. Like the deltas, the option delta was increasing so fast that like every 2 to 3 days I would be going from like a 20 to a 30, and I'd have to keep rolling. I mean, I rolled out like a year in OptionNet Explorer, and I actually ran out of expirations to roll to because they only go out a year in the program. And I was like, okay, this clearly, you know, isn't actually possible. So, and it also led to a blowout.
Evan's got a question or comment.
I've got 2 comments in the question. I'll start with the most recent thing you just said, that you ran out of strikes to roll to. And this is in the ES. I would say a strong majority of us are trading MES and will have even fewer options when it comes to rolling. So it's interesting that you ran out of strikes in the ES.
Well, I ran out of expirations.
I'm sorry, that's what I meant. Yeah, expirations. Yeah. So it's interesting though that you ran out on ES, because you would think, oh, you have unlimited potential there, but you really don't. And I think that's just a product of the fact that once we hit 30 VIX, 35 VIX, and the panic sets in and the market's dropping, everything just goes off the rails. There is no more peace. So it makes perfect sense. And I think after this conversation, I will definitely remove rolling from my my plan, because I was under the impression like, 30 delta, I'll roll, it'll be okay. But yeah, I'm really not liking it as much. The next thing I had, I liked seeing this visualization of the spreadsheet, because it really does show not only did we get the warning signs, but it also showed that once we stopped out, the chaos kind of continued. Yeah. And I think that one thing that probably wasn't accounted for is what happens after you close your naked positions. Well, if you close your naked positions at 30 delta and the market goes up to a 80 whatever VIX and it keeps dropping and it's going crazy, chances are you're going to leave your put debit spreads on.
Wow, that's right. You know, it's a good point, Evan. So
like that will probably recover a good portion of your loss if you just stop out, don't put on another naked position, and let the market freak out. Because what are the odds of you getting out at the very bottom?
Yeah,
not very good.
I agree. You know, it's funny that you say that. So I was actually just talking with Candy earlier today, and we were just talking about this. So I mean, what I'm going to do is I'm going to go into Option Omega and actually create 2 different tests, one just for the naked shorts and then one for the put debit spreads, and then put those both into the portfolio and see what would happen if I just stopped myself out of the naked shorts but kept the put debit spreads on all the time, because I agree with you that I do think that, that would cause something that I've not modeled that would be good. So yeah, it's a cool idea.
I think a lot of us would probably look at that and say, oh, well, those debit spreads, those hedges, those are going to cost us money as time goes on. But the reality is you could really just look at that as risk. Now you have a directional position to the downside,
Yeah.
and you have a capped level of risk. The most you can lose is what you paid for the debit spread. So leave it on, let it go. And there's going to be points where you're like, okay, this is 90% max profit. Take it off.
Yeah.
I mean, I love the idea of leaving those on, and now you have a defined risk position to the downside. And there's not really a whole lot you can lose there. Like you said, with the futures, you have undefined risk if you're short futures. So the market can rip up 10%, and now your futures are smacked, and the VIX is elevated, so your other positions are down, and it creates a headache. So
Yeah.
well, that was an observation that I had, and I do have a question for you if you don't.
Yeah, go for it. Yeah, cool. Yeah, great.
Looking at the P&L curve of your COVID models, it looks like the SPX portfolio outperformed everything or all of your tests, unless I was reading
I
that
saw
wrong.
that too. I know what you're talking about.
Yeah, and I didn't understand how that was the case, because I know that 112s, especially with your level of risk, should be outperforming the market by quite a bit. So I was just curious what was happening.
Yeah, it's a funny observation that you make. And the reality is there are scenarios where you can outperform the market. I looked at this particular one where you double up on the risk, and this is 34 contracts, not 17. And I was able to kind of get over the curve here, and yeah, it's that is an interesting observation, Evan. So the correlation of the 112 with the market is actually high, and more so than I appreciated, I think. And yeah, obviously we want to outperform the market, and in quiet times, like for example, this period last year, certainly in this year, we would be able to do that. The problem is you really need to manage the loss down here. I think that part of this, Evan, is that there is not dynamic position sizing. So the reality is that I would be, as I meant, geez, if my account was $3 million, I would not be at 34 positions. I would be at more like, 60 positions or something, right? So the reality is that like, this is not properly resizing as the account gets larger. I'm just using a fixed number of contracts, which isn't really the right way to think about it. So that's my, but I had the same observation, and I was like, I'm not quite sure what I want to do about that, but if I could figure out a way to
you're essentially lowering your buying power usage as your account grows, which for somebody who's just looking for a flat rate of return, maybe they want to make $1,000 a month or whatever on it, that makes perfect sense. But the reality is a lot of us look at our buying power theta delta metrics and we say, okay, we need more positions. So that makes a lot of sense. I didn't consider the fact that it was not adjusting for the account size.
Yeah, it's not, that's right. That's exactly why.
Awesome. Thank you.
Yep.
Okay, anyone else got a comment for Ryan? This is great. Ryan, you've done a lot of work.
Yeah.
Lynn says that Option Omega can do dynamic sizing.
Oh, good. Well, then I will play with that.
Yeah. So that's good. Yeah. And yeah, go ahead.
This is Glenn. Yeah. So ping me if you can't figure it out. I've played with it some. The 112, especially if you're going to break that apart and do a separate test for the naked puts versus the put debit spreads. I don't know how you would set that up that way. I'd have to give that some thought. But if you combine it all as one test, there is a way to do it. You essentially don't set, or you set a really high maximum number of contracts and tell the software to use 100% of your portfolio. Well, actually, I'm sorry, back that up. You start with a small percentage of your portfolio, so maybe like 20%. And what it's going to do is maybe give you 2 or 3 contracts, and then as the portfolio grows, it will start adding additional contracts. So you might have to play with some of the numbers.
And the max contract per trade needs to be much higher because
Yeah.
I'm putting in one just to max it out. Yeah, that makes sense. Yeah, I'll play with that. Yeah, and
Cool.
I'll connect with you if I have trouble figuring it out. But yeah, so for me, I was like, I'm not too concerned about it keeping up with the SPX because I just, I figure I can just deal with it with dynamic sizing. The note though is, you'd get to dynamically sized and you get to COVID and now you're at much more contracts. And so, there's the double edge to this, which is, even more of a reason to make sure that there's some stop management control.
But it sounds like you're at a point where you've got the confidence to survive another type COVID crash.
Yeah. I mean, I would be pretty stressed out about it, but I at least have the tools and the logic and the rules. And I also think the support, I think it's important that we in the community here have each other. I think that, like, as I think back to SVB and what happened a month ago, I think, we probably could have been daily communicating a little bit more about it. And I mean, I'll tell you, I was talking with Trey like 3 times a day, but like, I mean, us here in the rooms, just talking about what we're doing and what we're managing and how we're thinking about how the accounts are doing. Like, I think that's important and valuable information. And, we've got each other in those moments. And, and the question is this a break glass moment, or is this just normal volatility and everything's okay? Like, I know you and your sessions do a great job of saying, here's what's going on. But also I think that was a time when you were on vacation. It's funny, it's like the week where you were gone and it was kind of like we're all like left to our own devices. And I think, my note to self is, we as a community getting together and just saying, hey, here's what I'm seeing, here's what I'm thinking, and this looks normal or it looks not normal.
Yeah, that's the great thing about the community is everyone's willing to share, and it's been really, really, really great.
Yeah.
Any other questions or comments for Ryan? Okay, Ryan. Well, thank you for sharing and congratulations on your graduation.
Yeah, thank you. And I'll make a plug for you here for anybody who hasn't been through the mentoring. It is unlike anything else I've ever done. And it's the daily 1 month long connection, something about it that is very, very unique. And, the ability to continue to stay in touch with you and talk with Candy regularly. I mean, I feel incredibly supported, and I went up the learning curve very fast. And it really just, the daily, it's not the same information you're getting in the daily recordings. Like, it's more like, it's a much more focused on where your gaps are and like what you need to learn, and just life changing. So
Well, thank you. It was a delight.